The Federal Reserve Board just released its hypothetical scenario for its 2021 bank stress test. Hey everyone, I'm Dred. This article is courtesy of federalreserve.gov. Let's hop into the details. First, I'll summarize exactly what the bank stress test involves before looking at the most severely adverse scenario. The Federal Reserve Board on Friday released the hypothetical scenarios for its 2021 bank stress test. The board stress tests help ensure that large banks are able to lend to households and businesses, even in a severe recession. The exercise evaluates the resilience of large banks by estimating their loan losses and capital levels, which provide a cushion against losses under hypothetical recession scenarios that extend 9 quarters into the future. This year, 19 large banks will be subject to the stress test. Smaller banks are on a 2-year stress test cycle, but can opt into this year's test and must do so by April 5th. Now that we know some of the details, let's have a look at the severely adverse scenario. The severely adverse scenario follows the board's policy statement on the scenario design framework for stress testing. This scenario is characterized by a severe global recession, accompanied by a period of heightened stress in commercial real estate and corporate debt markets. In this scenario, the U.S. unemployment rate climbs to a peak of 10.75% in the third quarter of 2022, a 4 percentage point increase relative to its fourth quarter of 2020, and real GDP would fall 4% in the same period. The decline in activity is accompanied by lower CPI inflation, which quickly falls to an annual rate of about 1% in the second quarter of 2021, although inflation will gradually rise to 2.25% by the end of the scenario period. In line with the sharp decline in real activity, the 3-month Treasury rate remains near zero throughout the scenario. The 10-year Treasury yield immediately falls to 0.25% during the first quarter of 2021 and stays there through the first quarter of 2022, after which it gradually rises, reaching 1.5% by the end of the scenario period. In this scenario, asset prices drop sharply. Equity prices fall by 55% through the third quarter of 2021, accompanied by a rise in the VIX, which reaches a peak of 70. House prices and commercial real estate prices also experience large overall declines. House prices declined 23.5% through the end of 2022, while commercial real estate prices fall 40% through the first quarter of 2023. Now, the Fed says these scenarios are not forecast, and the severely adverse scenario is significantly more severe than most current baseline projections for the path of the U.S. economy under the stress testing period. The Fed's entire report is in a 24-page PDF. I'll leave a link in the description if you're interested. Thank you for watching this video. If you found it informative, please consider giving the channel a subscribe.